As we do every Tuesday, today is going to be another strategy update. But this time around, I want to touch upon a few things to talk about the sort of evolving global landscape that we have currently and how we in Helix, as your partners, we are navigating these kind of complex situations uh, and deliver robust, uncorrelated high returns. Right? I mixed up a few words in there. Said there is robust, there is uncorrelated uh, high returns. Right? And why is that important? Right? If we were to compare ourselves to other hedge fund structures today, we do not take a very generalistic kind of a view. We take a view that is focused on the energy transition, on the move towards greener technologies, the aspirations gap that we talked about in our previous few sessions, that we are looking at the younger generations, their expectations in the market and what they are getting. Based on that, is there an opportunity for the market to catch up? Right. So we are a little bit thematic while being broad-based from a sectoral perspective. We're not specific sector as such. We are broad-based, but we're quite thematic in the sense we are looking for companies that are both profitable and sustainable at the same time. So the way we've run this hedge fund so far since last year when we started off, we're still under the incubation sort of a stage. We are not yet a large hedge fund as yet. We are a fund that is under incubation, under formation, etc. The way we've done this is, first of all, look at one core portfolio. And this core portfolio consists of companies that we call eco leaders, right? These are companies that are adopting green technology, not necessarily manufacturers of green technology. So they are adopting green technology in sectors like food, transportation, housing, industrials, manufacturing, etc., right? So we take these companies as the core part of our portfolio, right? And we allocate a major part of the capital towards this core portfolio. And then we have satellite portfolios. And each of these satellite portfolios are quite specific thematic and structural shifts that we are talking about. One is looking at the energy transition itself, right? So those companies that are bringing in solar, wind power, small modular nuclear reactor power, those that are bringing in, electrification of industrial heat, so those sort of ones go into one satellite, right? We have other satellites which are like, take for instance, the adoption of electric vehicles and new fuels, right? So those companies that are doing really well in those areas. We're looking at another satellite which is to do with, the transition from various core industries like chemicals, pharmaceuticals. We are also looking at packaging. So we take that as another satellite. And what we then do is, in order for us to smooth the returns, we use a number of overlays. And these overlays are basically to look at the bond market, right? Looking at the bond market, can I use an overlay there which will kind of smooth the returns, and it can balance out the drawdowns that we will have in our core portfolio because as the earnings start coming in, there might be a bit rough patch here and there. So these can come in and smooth the returns for us. So that's one of the reasons why we've delivered anywhere between 6 and 8% every month. So some months are exceptionally good, but we aim to deliver 5% every month. and we've always kept that. So as an annual return, you're talking of somewhere around 60%, 70% easily. So last year we 84%. This year we're already about 65% now, right? So how we are able to do this is because we've taken these themes and these themes growing exponentially. That is primarily because of the fact that the under 30 population that we're tracking very closely, that is half the global population, right? If I took a situation which was purely based on, tracking the elderly age groups, then I would be looking at 1,000 different themes. So instead, what I've done is basically to take a standard theme. I looked at the preferences of the younger generations. There are 15 themes in there, all combined together into two separate factors. One is increasing market share for sustainable companies. And secondly, it has to be digitally interconnected. So if you take these two together, there you go. I've got my portfolio. So, and that portfolio, when I back tested it, it goes all the way back to about 2018 being profitable. Right now, when I'm looking at it, it is growing year on year. So that is how we are able to provide robust, uncorrelated, risk-adjusted, high returns. Right. So my goal today is to provide more of a concise but comprehensive overview of the sort of key macroeconomic developments, underlying structural shifts that are shaping our investment thesis, and why you can use this and you can develop your own investment thesis as well, right? So first of all, let's start with the sort of macro picture, right? I will look at one side of it, which is the inflation, and then I will then contrast it with the various expectations that we have, right? In the sort of developed economies, we are looking at inflation remaining persistent, right? I'm not going to put numbers to it. I'm going to put a word called persistent, sticky inflation, sticky core inflation. And it is, partly driven by the fact that there is a cost of trade barriers that are got, right? So here in the UK, EU is our biggest trading partner, and we had a divorce a few years back, and that caused excessive trade barriers, and that led to supply chain related disruptions, and thereby there have been, an increase in, inflation because of that. But the US did a willful job of putting in trade barriers. I think what Trump is trying to do at this point of time, I think he's doing the right thing in terms of protecting manufacturing jobs in the US, bringing in more investment into the energy security of the US. Except he's doing the right thing. The way he's doing it is not right. Right. And the reason why I say that is you can't achieve all of this without the help of the trading partner. Right. So you cannot do this by antagonizing trading partners. So your trading partners are key to your supply chain and you work with them. That is the only way you can achieve all of what you want to do. Unfortunately for the US, those same trading partners are the biggest holders of US debt. And the unfortunate fact is that due to quantitative easing and the response to the global financial crisis, the US's debt has ballooned beyond a point. So with his big beautiful bill, I can't really see anything big beautiful in it, but let's call it that. But the big beautiful bill that he's got is basically trying to kick the can down the road. But In order to do that, you need more and more buyers of US debt. How do you achieve that? By antagonizing those same buyers. That is a fundamental problem. US, which then kind of accelerates, propagates to the global economy as well. Right. Now let's take a pause at that, and then see why this is important. Now, because of the dollar's use as a global reserve currency since the 70s, when even before I was born, right? So it's been a global reserve currency. So what this means is, to hold a global reserve currency status, it means that your cost, everybody is going to be um, maintaining their reserves in US dollar, which means that your ability to raise debt is good. Your ability to hold interest rates stable is good. But then it puts an emphasis on the structure of your economy, which is that lower, I don't want to use the word lower talent or something like that. Basically, it's things like manufacturing, for instance. If you ask people around how they lost their jobs in manufacturing, I'm fairly sure they're not going to tell you lost it because my job went to China, right? In 99% of the cases, they lost their jobs because of automation, robotics, the assembly line kind of automation that came up, and it's been happening all the way 80s onwards, right? It's a relentless path. So blaming China onto it, blaming immigrants onto it is not right, right? And can you bring back those manufacturing jobs? So if you look at the political commentary at that time, like in late 70s, early 80s, going back into 85, 86, is that those jobs are gone and you have ups, right? So manufacturing employees, miners around the world. And I would say pretty much the same thing happened here in the UK as well, right? So when automation started taking place at a very large scale, you found that you were asking people to upskill, and the structure of the economy has changed. So you wanted people to upskill, wanted people to learn various other skills other than the manufacturing kind of thing, where I can lift and shift this particular thing, or maybe press it into this particular machine, and whatever. Those skills changed. Now, if you want to go back and do that, you first need to reverse the cycle of automation, go back into people jobs, and you need the same people to unlearn whatever they've learned and then learn again how to do this, with the manual work that you are doing. Is that going to be beneficial to us? That's a fundamental question to ask. Or is there a better way to do this? Now, staying on the subject of, basically the reserve currency status and the way in which central banks are kind of managing the situation right now. Now, this week we will see the Bank of England making its interest rate decision. The Fed is in a wait and watch, right? Uh, the market is constantly rating. If the Bank of England comes up with another rate cut, or in their policy language, if they are saying that there's expectations of a rate cut going forward, people expect the market. But there is a divergence in the monetary policy that is going on, which I don't think many research firms or economic analysts are talking about. On one side, you have the Bank of Japan, you have the Swiss National Bank, you have the European Central Bank. The other side, you have England, you have Fed, uh, the RBI in India, etc. So you are seeing an imbalanced situation where some economies are focused towards, I will cut the rates and stimulate this economy. In other ones, you want to hold the line, want to stay with whatever rates that you're maintaining at this particular point of time. This divergence is not very common. This is not something that we have seen since the financial crisis. We are seeing central banks pretty much in line, right? So if there is maybe a rate cut by the Fed, the Bank of England will do a rate cut the next month or so, and then you would see pretty much the same thing going on in Europe. You would see pretty much the same thing going on in India, in Singapore, in Australia, pretty much everywhere. It was one single stance all the way 2009 until now. Right now, we are seeing a divergence. Point to be noted. We have to see this in conjunction with the astronomically high debt situation that so across the developed markets, we have astronomically high public debt, which means that the ability of governments to spend their way through any crisis is quite limited. Right? At the same time, can they invest in public structure? Can they invest in um, maybe in stimulating the economy? Can they bring in additional stimulus for the labor market? Unfortunately, no. Most of the developed world, most of the G20 economies have their hands stuck. So today we are at the mercy of private capital. So unless private capital comes in, unless we any new public infrastructure projects in the G20, it's probably going to be only PPP. It is definitely going to be a public-private partnership for projects. We will see. Can the government basically bring back British rail? Can we bring back British energy, etc.? The reality is there are efforts that are being made in these areas, right? Renationalize some of our utilities, etc. How successful that would be is a question. But when you try and renationalize, what could potentially happen is a mechanism by which you invite a public participation in that. So it is not purely a government spending. It becomes basically like a method by which you're selling the shares of the market. Just speculating on that. That is possibly the way. Now, if we look at what is going on from a corporate earnings perspective, just looking at the S&P 500, overall EPS growth has gone up by about 13%. Right? In the last quarter, what we've seen, EPS is growing at about 13%. It is almost double the initial expectations. There are two reasons behind it. And this is where I kind of say to be cautious about it. That is because nearly 78% of S&P companies have beaten estimates. That is not something that we see every single time, right? It is always a 30%, 40% beating estimates, and the rest will fall through either at expectation or below expectation. That is how we've seen the market all along. Now we have a situation where 78% of I want to go back and see how reliable are these estimates. I want to go back and I want to also see how reliable are the earnings. And I use various math to test it. From my understanding, what is happening today is in many of the cases, companies are trying to take a cautious outlook for the rest of the year, and they are probably booking sales earlier on, accruing the revenues earlier on, so you can capture value at this stage with an expectation that it could be lower as you go on. So uh, that is one of the factors that I see. The second reason why I also have a concern around this trade tensions. Right, this protectionism, anti-globalization sort of a stance that has come in. So any supply chain disruption due to this adds that, and it will not show up in corporate earnings right away. It will show up in corporate earnings over time. That is one of the reasons why earnings estimates were beaten now versus later on. So this increased uncertainty in the policy, this kind of flip-flops that we are seeing, right? Unpredictability in tariff. So for all these years, we had pretty much a stable trade situation. Globalization was right or wrong for for some countries it was wrong, for some countries it was right. Whatever maybe that we so I keep saying this: a good policy that is stable, fantastic. A bad policy that is stable, fantastic. A policy that shifts between good and bad constantly, not good. I think that is where we are. We are doing this flip flop again and again, and this is the issue that we as traders, hedge fund managers, investment managers, with the um, sort of issue. These tariffs will act as a inflationary trigger, right? So when there is a supply chain disruption, automatically prices will start going up. So this can impact not just the goods alone, but the tariff impact is on the goods. The goods are then used to create services, so it will impact services. And these goods and services, when they are not able to balance itself and it is not in a stable equilibrium, it will impact us. That is the situation that we are likely to see a historical wealth transfer from the middle class into wealth. Why is that concerning? The middle class was not very significant 100 years before. So anywhere except the US, probably saying maybe 50, 60 years, maybe 70 years before that. So it was quite considerable. You had maybe 1,000 people who were rich, then the rest went done. What was the situation in the world? So what we did after the World War was in the sand. You stay in your territory, stay in my territory. I'm not going to be, fighting with each other. I kind of draw a line in the sand. That's the rule of law. What is happening with the tariffs and also with the increased situation with America saying EU needs to contribute to its own, etc. It's fine, but if when all of it comes at the same time and all of it hits you at one particular point of time, this creates a situation where see a wealth transfer going into they have excess capital that is available. So when you have inflationary pressure, and when you have a situation where you have the impact of supply chain, etc., some small businesses, medium-sized businesses would want to give up. Who's going to buy? They want some people could give up their property, and who's going to buy them? These are the people who have the money to buy them. That is where it is concerning. The kind of ongoing geopolitical conflict situation kind of adds a little bit of control into this. So I don't think the Ukraine-Russia conflict nor the crisis in Israel, Gaza, etc. I don't think any of this would end anytime soon. These are probably going to be continuing for the rest of the year, maybe into next year. It creates an increased geopolitical risk when we essentially look at it from, and I call it the fear premium. The fear premium is because as an investor, I need to be about what happens to trade, what happens to oil, happens to the treasury, etc. So I'm constantly re-evaluating that. That fear premium is going to be there. But looking at the Israel situation alone, I don't think it is in America's interest. There will be intervention, and on top of it, it does not have a oil price perspective. We would like to see it in put a ceasefire in there and stop that. Now, coming to the energy transition and talking about oil, whether automatically the next thing in my mind is to look at the demand. There's also an interesting sort of a situation. The OPEC says there is increased oil demand, and we're going to be producing more and more. Now, the IEA says in their outlook, they say this big demand is already inside; it's going to nukes. Right? Now, who do I believe? Now, every research firm that I follow is trying to base their estimates anywhere between the two. Right? One extreme is OPEC, other extreme is IEA. Now, the way there is an accelerated energy transition today is that I call green energy as a more equal energy, right? And there are some reasons for that, right? Why I say that is, if you look at oil, somebody owns that land, somebody owns this, they've invested a lot of money in it. It is in their best interest to keep prices high. Now, if I look at solar or wind, that energy is everywhere. As long as you can invest in putting a solar panel or maybe a solar water heater in a house, you can tap into that energy. So it's more equal. Anybody can literally access it very easily. Electric vehicles, again, the same thing. I would say in comparison to a internal combustion sort of a vehicle, this is more of a equal kind of a vehicle that we have in hand. The reason why I say that is, you know how it works. It's as good as a washing machine or a dishwasher or whatever. Just plug it in, you charge it, and then basically when the battery is full, you start driving. Now, a lot of people keep saying range anxiety. And I was not much of charging infrastructure. I think I'd like to split that word into two parts. There is range and there is anxiety. A lot of work has gone into managing the range, which means that can I put better batteries in here? Can I put more charging infrastructure on our motorways? Can I bring in those Tesla superchargers, etc.? I would say do something about managing the anxiety. Right now, I'm driving a diesel car. Right, for all my practical purposes, I've used a diesel car. I don't see minute by minute, mile by mile update on my fuel gauge. My fuel gauge is very simple. It's got empty fuel and empty full, and then there is some mark in between. Why does an electric car need to give me, like, you've got 12 miles, you've got 120 miles, you got 119 miles to go. Why do I need that information? And then secondly, if I look at, an app like Waze, for instance, what I can do is I can figure out where is my nearest petrol station. So I know that I have, half the tank. I'm driving from here to Manchester, and then I find, okay, I can refuel in about 100 miles. That's it. It's all that I need to know. But if you look at, people using an electric car, their brains are being fried by the anxiety, right? Which then, limits the adoption of that technology. So I had a friend come in to an event in Coventry last year, and then he was saying, he drove down from London and to Coventry, and he was saying the way they stopped somewhere for a charge, and then that was a slow charger. It said that there was a Tesla charger that was available, but it was not even commissioned. So maps are not reliable. That needs to be reliable. So just like I'm able to see something on Waze and then say, that's, I can refuel in 100 miles. And then what is the price of the fuel? Whether it is reasonable for me, I shouldn't be paying too much. So I can check with whatever I paid locally over here. If it's reasonable, then I would go and refuel there. I mean, something similar for electric vehicles. So that would make it a lot easier. What this person actually did was to drive down 20 miles, go to another, service station where he could find, the Tesla supercharger. He charged his vehicle for an hour and a half. And when, the gauge showed him that he had 300-mile range, he was happy enough to come back to the event and enjoy the rest of the day. So for about 1.5 days, his brain was being fried by that anxiety. This can be easily sorted out. You don't need a high-tech solution to it. This can be a low-tech solution. If somebody is listening to this, is willing to create a solution for something like this. Very easy to get more and more electric car drivers on the road, at least here in the UK that I've been talking about. Other countries might be quite similar. The circular economy in itself, it's been gaining traction every single quarter, right? While Trump can come in and say, I want to get rid of climate change, I want to do this. The reality is that in the US itself, most of the incentives for this lie at a state level, not with Trump. So his executive order and his actions over there are going to have very limited impact during this term. Right? That's the reality. Secondly, by diluting the EPA protections, which he's trying to do currently, what it does is oil is not one of those fuels that will give you a strategic energy security. Unfortunately, going with oil means that you will never achieve a strategic energy security. You will always be dependent on newer and newer projects coming in, which need a lot more debt, and which means that the dollar strengthening is not going to be helpful for that. And on top of it, the trade tensions means that getting capital into the country for you to invest into this is also going to be challenging. In comparison, renewables can give you a much better energy security than anything else. So for all the stuff that I don't like about the IRA, I think some of the good provisions in there have helped in invest in renewable capacity, have bring in climate technology and acceleration in the US, which then also led to a lot more impetus for green investment by various companies. Now, you could argue saying that many public companies have diluted their targets. They have, let go of their commitments, etc. My view on that is they never meant to meet them in the first place. So those that diluted it at this particular point of time, when they had the first opportunity to dilute it, they diluted it. So they never meant to meet them in the first place. So I never took them seriously at all. Right. So who do I take seriously? I look for quarter on quarter improved. And again, I'm not somebody who is, interested in understanding whether the absolute emissions is so much. I don't care. I want to know how much is your emissions per bag of cement you produce. I want to know how much of your emissions per ton of steel that you. That is more realistic rather than knowing what is my scope 1, scope 2, scope 3. I don't care about it. Secondly, the other aspect that I also, just looking at emission alone, not going to be helpful. You have to look at talent today is a big issue. You've got AI coming in, you've got automation at scale. You have basically a Gen Z who is being antagonized at its maximum possible capability by employers who think what they do is right. Now, as a business, if I don't understand who my potential employee is, and I don't adapt to it, I'm not fit the business. But unfortunately, you see that out there from Morgan, from these companies. Okay. So you blame Gen Z for this. Reality is, what they are aspiring for, you're not able to provide. You better move out of the way. You might want to take a stand. I will not hire anybody below 30 years of age. I will hire only the elderly. Live with it, right? That is better than trying to impose what you want onto a larger population. They are half the population, right? They're half the global population. You better understand how they work and adapt to workplace. There are many companies that are investing in employer branding, recruitment. They want to bring in the right talent at the graduate level in early careers, etc. And many companies that are doing that. But we also see like those companies who are taking a stand. That antagonizing stand will only lead to one outcome, meaning you're not going to be engaging with the younger generation. Because if you then look at how things are happening on the American edge in business and in the global economy is driven by a fundamental nexus between academics, government, Now, we've already antagonized the best academia in the US. We've cut financing that. We have blamed them of various things. We, um, we've tried to pull out immigrants, etc. At one side. And then the other side is basically the nexus is kind. So with that nexus being broken, the long-term viability of academic research becoming more valid, used in the corporate space, used in government, and becoming more and more scalable, bringing in more innovation in the workplace, in government, in corporate, etc. That ability is being done. That's the bigger problem than AI problem. The AI problem is solvable from the perspective that if we, yeah, there's always this word about, do we have need to have increase the scrutiny, increase the scrutiny, increase duration AI. No, I think what we need is increased adoption. As we adopt, it will fall in place. And in a capitalistic world, talent and your employment in itself means that you are disposable. Let's face it, you are disposable. The moment your revenue per employee, you are maybe generating revenue company, and your revenue per employee is lower than the standard. And you find that there are additional costs of doing business, then what are we? This is a fundamental way with that. So when AI comes in and says, okay, I can do what my employee did in 5 days, whatever they did, I can do it in 5 minutes. Companies are going to adopt it. It's a reality. Companies are going to adopt it and they're going to throw you off. So how can you, uh, you know, reskill, upskill, and make your presence felt? It is that simple, right? But can you stop AI from taking your jobs away? So there is already at least about 500,000 jobs that have been lost to AI. There's at least another 1.5 million jobs that are at risk of being replaced by AI. So things will start becoming a situation where we could be sitting here 5 years down the line. We could be sitting here and saying, "Hey, now the economy is growing, but earnings are pretty good, but there's heavy unemployment. What do we do about it?" That could be a situation, but we are not there. We are not there yet. We still have the time to. Right? And how do we act on it? Just like we said in the 70s and 80s, we could go back and say we have to upskill, reskill the workforce. But here's a double whammy for us. Just looking at the UK alone, the skill gaps are about at the entry. But then not many employers invest into apprenticeship. Right? So you've got to get that training, that reasoning elsewhere. And that means you've got to pay for it. That is some of the unfair realities that we are going to be facing. So are we going to change this? Are we going to enhance this? Are we going to make something different? I don't know. But the interesting kind of triangular relationship we are interested in. But social one side is financial, one side is environmental, as we talked about. This sort of a triangular relationship we are interested in. Is that Uh, well, if you look at ESG and impact related, looking at the um, even though there is political headwinds, investor interest in ESG and impact related themes is growing. Every quarter, we are seeing more and more being allocated in these themes. And the way we look at it is we've taken the ESG, put it onto steroids, and put that's what economics is. We are also very mindful of the sort of greenwashing. That, in fact, one of our satellite portfolios is tracking greenwashing litigation, environmental litigation based on the structured short. So we make money whenever somebody greenwashes, and there's no shortage of it. There's so many companies. If you name it, every big name has been accused of greenwashing. There's basically litigation against them, and we take a shot at it. Where we'd like to be is a situation where these greenwash litigations reduce, more and more companies are more pragmatic in their approach towards ESG, and they are bringing in ESG as a profit making. At present, unrealistic companies do that. If you know of it, let us know. With that, I would like to conclude. So I call this as a new global paradigm that is evolving correctly. So we are now, uh, as a hedge fund manager, as a trader, I cannot just simply react to hedging. I have to look at it. And today, my biggest challenge is 20, 20, 25 years back, I had an 80-20 situation, meaning 80% noise, 20% thing. Today, we have a 99-1, meaning it's 99% noise and there's so much of noise. And again, and actively dissecting these independent forces, we crunch on um, looking at the technology, looking at sort of human capital requirements. So that gives us abundant number of opportunities. So our signal system kind of throws out to the every single day. So we can see pretty much that obviously the signals are available. Use it and use the advantage or the key differentiator between our signals and anybody else's signals is use it. So, uh, so you can see our platform directly. You can see that they're using this data one. Go ahead and use it. I have my uh, for us, we are operating pretty much in a very the thesis was published by the book, read it, use it, investing. The research that we do, different, uh, uh, use that, go ahead and use it. The signals that we use for our trading, that's public. And do it, you can use. We use the same signal. It's So our focus, obviously, is on application, the statistics, being uncorrelated to strategic positioning across a diverse set. So our method is quite agile, quite proactive kind of a method. Very, very deep research. Uh, thank you. The support so far. Many of you have in the last week or two asking for help and guidance in terms of your own journeys, etc. I'm always happy to always here, always here to kind of learn from your seeing in the market and at the same time my insights. Thank you. On being on over here. Feel free to ask me questions.